Welcome to the Schwab Network's Look Back at 2023. I'm Jenny Horne, and over the next hour, we'll discuss some of the biggest interviews, key takeaways, and best discussions we've had here on the network in the last year. One key theme that's driven investor sentiment all year long has, of course, been the Fed. Since March of 2022, we've seen 11 rate hikes. So naturally, as we head into this new year, much focus will be on Jerome Powell as well as the rest of the Federal Reserve.
You know, the Fed is obviously taking the foot off its brakes. They see something that may be breaking the economy that's slowing, and that looks like it started, in fact, in December. But the reality is, overall, it still looks like the economy and corporate earnings are still in fairly good shape. So you really have a tale of two markets, tale of two worlds. And that doesn't really bleed today to show you that the Fed should be cutting rates. So part of me thinks the Fed is just jawboning here and letting the market do its work for it. But, you know, honestly, if you go back to, 2017, 2019, and you look at the dot plots, it was showing 2023, we should have something like 0.75 basis points. And we're at 550. So they were wrong then. Mm-hmm. And obviously, it looks like they will be wrong again. And then the question is, if the Fed is wrong, what do you do about it? And what ultimately does that mean? And for me, it looks like we're still in the potential for a hard landing.
You strike me as a man who believes in the wealth effect of financial markets, I would argue then.
Isn't it ironic now that we can pivot over to talking about mission accomplished for
now
Powell,
you know where
right?
I'm going with that.
Right, absolutely, right? I mean, if the market continues to rally here, and guess what? Interest rates come down, so now investment in real estate goes back up. A lot of other areas, it stimulates the economy. Is it going to be mission accomplished? You tell me. Especially in the face of what we're still seeing very secular effects on services, on labor, right, that are very, very strong and still very, very hot. We're at 3.7% unemployment.
Yeah, financial conditions
is it time to pivot? Inflation is down enough. They can make the argument that mission is accomplished, but it is rhetoric, and don't forget about that. It is rhetoric alone. This will be another transitory moment.
Store for another big round trip for yields?
Not only will we see a round trip, it's not going to happen as quickly this time around, to be clear.
Okay.
But I definitely think that we'll be higher than 5% by the end of next year.
Oh, I was just about to ask you to give me a next year 10-year call, and you got ahead of me.
And this one will be more interesting because it'll be steepening. I think the cyclical reinvestment here will really stimulate going forward. People will start picking up on that on the longer end of the curve, whereas the pivot itself will bring down the front of the curve a little bit.
It was a fun week. What did you make of the way Powell really seemed to embrace what the bond market has been pushing him towards?
Well, listen, I mean, I'll give Fed speak for a second. He'll see himself as data dependent, and so the data is now indicating 75 basis points. My good friend Ron Asana and I had a call this morning. I think it's going to be more than that. I don't see how it ever stops. The pendulum, when it moves, it doesn't ever just stop in the middle. And so I think they end up doing 150 basis points next year.
Okay.
Now, the question is that already built into the market or not? I don't know. We've had a pretty big move up, Oliver. So we'll see. But here's a fun fact. 83% of the time, markets go up during an election year since 1900.
Oh, now you're just making me remember that I need to ask you another question related to next year. Anthony, you really hit the nose on the head, though. That's why I was saying I feel like you're the perfect guy for today, because the most interesting thing to me is that the Fed gave us the 3 cuts on the plot, but the market, which had been looking for 4 coming into it, took that 3 and now turned it into 5. So we've got 130 basis points priced in. So when I hear you say you think it's going to go full pendulum back, I want to know why you think that, because it seems like that's what the market keeps going towards as well.
It's just the nature of things, and it's also the likelihood that once a recession starts, if there is going to be one, it moves very quickly. I'll take your viewers and listeners back to 2007. Dr. Bernanke said, hey, I've got this under control. This subprime problem is $90 billion. I'll just ring fence it and take care of it. He couldn't contain it. Once the prairie fire started, the $90 billion went to a $6 trillion problem. And so what happens is they're data dependent, and that means they're lagging as opposed to being proactive. And so they're gonna miss some things here coming into the second half of 24, and they're not going to want a steep recession, so they're going to hit the elevator on rates.
I'm now joined by senior options correspondent Tom White. So Tom, I think this year has been somewhat of the year of the Fed, but overall, in your opinion, how did the Fed shape markets this year?
Well, I think it was all about the Fed, between the transparency that they've talked about for years, getting into the Fed, kind of laying out their plan. If you look at the 10-year yield, I think that kind of tells the story. The 11 straight meetings of rate hikes before the pause towards the end of 2023 kind of set the tone for markets, because they tried to put a little bit of restriction on the risk-on aspect of the market because of rising inflation, where the CPI topped out at about 9.1%, getting back towards that 3% level by the end of the year. But it was all about the Fed speak. A lot of, I guess, push back and forth between Fed Chair Powell, his mandates on whether it's inflation or the jobs reports, or also the fact that some of the Fed governors may be pushing back on that a little bit. But most of the meetings were unanimous in their decisions. But yeah, it was definitely about the Fed, and the push and pull between the asset classes at the Fed basically pushed around, which was yields and the dollar.
I do agree. I do like to see sometimes the disagreement between the other Fed, spokespeople, and then of course Jerome Powell. But I feel like the narrative has gone from inflation to then disinflation, and now the question is deflation. What does 2024 look like? So, what are your expectations overall for the Fed now next year?
Well, we got the pivot at the beginning of December, right? And then this was after the third straight meeting of them not doing anything, holding that terminal rate steady at about 5.1%. The expectations that the market's putting in at this point are for anywhere from 4 to 6 rate cuts in 2024. Now, that's going to depend on a lot of things, because the Fed's basically come out and said, hey, we'll do 3 cuts, 75 basis points for the markets, but the market's wanting more at this point. Now, how does that happen? What does that mean for equity markets heading at or near all-time highs into 2024? Well, it's going to be dicey, because I think it's going to turn from that inflation talk, rates at higher levels for longer, into what does it mean for corporate America? Can companies deliver on earnings going into 2024? I think that's going to be the key for markets moving forward, just due to the fact that we're at elevated, historically elevated levels as far as valuations going into 2024. So watch through January and February when that first earnings season kicks off. I think that's going to be a real key and a telltale sign for markets for the rest of the year.
And so many of the economic data points we've gotten, especially recently, have supported the Fed's narrative. Right. So, I mean, I do think there's the belief they're on the proper path, and I'm sort of curious your thoughts then on the Fed's now path into this new year.
Well, the market wants one thing. The Fed's on a path for that soft landing. That's going to be difficult to navigate historically. We don't have soft landings, right? Will we get driven into a recession? Will jobs continue to rise as far as the unemployment rate, which is still at or near historical lows? So you have to take those into consideration. If the consumer can hold up, they've been holding up the markets through 2023. Will that happen again in 2024 as inflationary pressures come down? So the soft landing is going to be the narrative, and that's going to be the most difficult thing, along with, as I mentioned, corporate earnings.
Yeah, that's been nearly impossible, I feel like, to gauge, and everyone's tried to guess, of course, naturally, but we will leave it there. Yeah. Great breakdown on all things the Fed, as that's one of these stories we discussed most this year. Now, coming up next, we will turn our focus to the world of tech. AI helped drive a recovery in the NASDAQ this year. We'll look at the saga surrounding Sam Altman's firing and return to OpenAI, and the drama that has followed Elon Musk as he attempts to balance his roles with Tesla, Twitter, and SpaceX. That's next on the Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
He's Alex Coffey. I'm Jenny Horne. Join us for Next Gen Investing,
1 p.m. Eastern,
only on the Schwab Network.
Welcome back to Schwab Network Year in Review. I'm Jenny Horne. Now, 2023 may be remembered as the year of AI. The so-called Magnificent Seven drove a tech rally and saw NVIDIA cross the $1 trillion valuation mark. You can expect that AI will continue to drive headlines in the years to come. Let's take a look back at our coverage.
Clearly, there are significant risks that are associated with AI. You know, what if some of those AI machine learning models are trained on bad data? What if they have an inherent bias? You know, what if you can't control, you know, some of the bad results that some of the generative AI generates? So there are definitely concerns, but I think it is too big of an opportunity set for the regulators to step in and try to control. I think there is absolutely going to be some regulations, you know, along the way and perhaps along the periphery, but I don't think it's going to be enough to deter the momentum of artificial intelligence. I mean, when I think about, you know, the FOMO, the fear of missing out, you know, maybe you have that in the stock market, but you also have that in the spending surveys, for example, of chief technology officers. And over 50% of CEOs and CTOs are saying that this is the top spending priority. And over 65% of those same technology, you know, procurement managers are saying they're going to boost their artificial intelligence investments in the next year. So I think given this momentum, it is hard to kind of regulate that out. So having said that, I do look at it as an opportunity, and we've had a bit of a reset in some of the artificial intelligence valuations as well. And the implied distance between where the stocks are trading and what the analyst forecasts are for their price targets, that distance has improved. So I think the risk reward has improved for stepping into some of the AI stocks.
That's worth noting because we've been hearing for a while that some feel like it's a risk of an AI bubble, similar to the tech bubble in the late 1990s. But then we started to see actual tangible products and services that are being offered, and partnerships like the huge Google Cloud event that happened this week that showed actual tangible things. So with these tangible examples, do you think it's still a risk of an AI tech bubble?
No, I don't think so. And, you know, you pointed out very rightly that these are tangible developments. If I look at a company like Broadcom, if I look at a company like NVIDIA, if I look at a company like Marvell and a lot of others, they're guiding towards the benefit of AI. They're seeing now, they're likely to see over the coming quarters. So it's not just hoping for that benefit to materialize in the next several years, but it's actually here and now. It's nascent, but it is happening today. So that's the first thing I would say. You know, the second thing I would say is when I look at the analyst models and what they're forecasting for artificial intelligence, it's not the doubling in spending on AI that a lot of industry forecasts are penciling in. For example, IDC, for example, projects that spending on artificial intelligence is literally going to double per year over the next several years. That's not what you see in some of the earnings models for AI beneficiary stocks. So I think what ends up happening is, to the extent that we go through this multi-year investment cycle of artificial intelligence, as AI take-up materializes, analysts will mark up their earnings estimates. As a result, the stocks may not actually be as expensive as they might appear because that EPS number is likely to trend higher.
Magnificent Seven, many of them have AI exposure and AI development and research and development. It's an exciting time. In a week or 2 or 3 months, what should I be saying to people here when we talk about AI?
Well, so let's go back and say that OpenAI did something brilliant when they decided to put chat in front of GPT. GPT models, these large language models, existed before, but nobody decided to put such a easy conversational interface in front of it so that everybody could use AI. So that takes us to this next step that you're talking about, which is, well, you know, does that mean that OpenAI is the end-all be-all of AI innovation? No, it does not at all. I think that cat's out of the bag. We're going to see a lot of other companies are already lots of incredible innovation happening across the board, lots of different companies. And remember this, I'd also say this, OpenAI didn't really have an enterprise grade revenue driving kind of strategy that we could see, at least that I wasn't really happy with. So they kind of, if you saw the last news, they were talking about being a consumer focused kind of business model. So, when it comes down to it, where we really see value and corporate value, in my opinion, is when enterprises can leverage these kinds of things. And I think those are safe. We're seeing lots of innovation outside.
I'm now joined by Renita Young, senior markets correspondent here for the network. So Renita, where to begin? I mean, what stood out as far as AI goes when covering the overall tech sector?
Well, the obvious place to start is with NVIDIA, the top beneficiary of the AI trade, leading all of its other peers in gains this year, up far above 200% year to date. So we saw that there. Another name that we saw that was another huge beneficiary of AI was the ticker AI, C3 AI, which did so as well. But sometime along the summer, we started to see the excitement for AI sort of level out, and we saw that happen in the performance of the NASDAQ. If we take a look at a year-to-date chart of it, we saw it level out, and behind the scenes, what we started to see was the separation of the wheat and the chaff between the companies that were promising AI things, AI developments, and then those that were actually delivering on those promises, right? And then later on, we heard from the companies who said, I'm not new to this, I'm true to this, like Amazon, who claims they've been using AI in AWS for around 20 years, as well as Apple, who said that their AI work goes all the way back to 1987, when the company introduced for the first time the Knowledge Navigator concept, which is actually driven by AI algorithms. So we saw a broad spectrum of AI developments this quarter, but a lot of it was talk until it truly showed up in developments, partnerships, and most importantly in revenues.
There was, of course, no shortage of ways that AI could disrupt everyday lives. Hopefully it won't be taking either of our jobs anytime soon, of course, but Elon Musk was another early investor in OpenAI and has made some big efforts to develop his own AI team, but his day job does remain as the CEO of Tesla, of course, which began its rollout of the Cybertruck in November. Now, Wedbush's Dan Ives joined Nicole Petalides to discuss what the Cybertruck means for the future of the company.
It's a historical moment for Musk and Tesla in terms of not the launch of Cybertruck. What that means is another growth, what I view as a growth vehicle. But really, this is part of the halo effect. I mean, it's something where I think Tesla, not just investors in the industry, have been waiting for. And I view this as the next phase of the Tesla growth story. It's Cybertruck, and then eventually there's going to be the sub $30,000 vehicle, and I think a handful of other cars that where this is all heading.
So, as we talk about the Cybertruck, and I know there's no delivery numbers expected for 2024, could it most likely be a winner overall? I mean, I know it doesn't feed the bottom line as much, but it's a brand thing, right? It's super cool, it's bulletproof, it's made of steel, it won't dent. Everybody's going to want one. Is that what we're getting at, even though maybe some people won't admit they think it's ugly?
Yeah, look, I mean, Tesla's been here before, right? I mean, many for the last decade have, I think, been doubters and been proven wrong again and again by the Tesla growth story led by Musk. And here it's on the edge, at least from a design perspective, but it's millions of reservations. Now, look, let's say 40, 50% of those convert. This is going to be steady state in the 25 to 250,000 vehicles per year. And that moves the needle financially. And I think that's the key here in terms of Musk unveiling.
When we think about EVs and the demand for EVs, I mean, I think the theme is that EV demand has been slowing some overall. Are we going back to a more hybrid theme? Maybe not exclusively EV, maybe people don't love EVs as much as they thought. In 10 years, is it going to be EVs the way we thought, or something a little different?
I think it's somewhere in between. Now, look, 3-4% of autos, does that go to 40 to 50%? Okay, let's say it goes 20%. We're still talking about trillions of dollars of conversion. I do think if you read the room, in terms of what Mary talked about in the GM call. I think they're even walking back a little from hybrid and in terms of where ultimately this is going to go. But the reality is that Tesla continues to really be the driver in this market. And from an innovation and tech lead and scale and scope, at the top of that mountain is Musk.
And that may be very well why Mary Barra is walking that back. You know, they had the UAW, they made this settlement, and one of the pieces of the settlement was less spending, and some of that less spending is actually, adjusted spending outlook is going to be on less on EVs. And maybe they're just not trying to compete in that space as much, maybe because Tesla is such a leader, maybe because there's so many other names, whether it's BYD or, I don't know, what would you say is second to Tesla?
I think BYD, clear. I mean, if you look globally, that's number two. But I think what's happened in GM4, what's happened across the board, it's like you're starting to see the scale and scope is the complexity. To get to that point, to get to go to market, it's hard. And I think ultimately it's really Tesla has such a lead. This is really, in my opinion, their way to almost stretch that, at least even from a mind and market share, as this arms race does play out in EVs in 2024.
And look, this is an AI stock. It's a charging company. It's a battery company. It's this, it's that. It's got the genius of Elon Musk. And I've heard price targets as high as $4,000. Why isn't this $1,000 already if it trades more like a tech stock, not like an auto stock? Why isn't this $1,000 yet?
I think it's just the first phase of the Tesla growth story in terms of where it's going. I mean, my whole argument has been, if you look at it just as an auto company, you're missing who they are. I mean, that's saying LeBron's just a basketball player, Tiger is just a golfer, you know, relative to who they are. From a technology perspective, in terms of FSD, battery technology, supercharger, this is just the next phase of the global Tesla growth story. 310's our base price target. If you look ultimately, you know, where this heads down the road, I think this is one where we're going to look back on this as a historical pivotal moment for Musk and Tesla.
Okay, so Renita, we just heard from Dan Ives, who of course I think illustrates so perfectly the bull and bear narrative in Tesla. I mean, not just this year really, but most years, and that's that how should Tesla be valued? Like a tech company, like an auto company? And to his point, this is still a growth story. We can't expect this name to be a pure play tech name really yet, but I think that he makes a really good case, because then the bears argue this is an auto company. And how do you go about weeding through all of that noise when you're covering a name as big as Tesla?
Well, at the top of the year, my biggest question was, am I covering Tesla or am I covering Elon Musk? Some would say they're one and the same, right? Because we started out with the whole Twitter debacle, which some people describe it as, because Elon Musk was the CEO of 3 companies at one time. We've got Tesla, SpaceX, and then Twitter. And so during that time, we saw very early on just a few analysts saying that, is this going to be a distraction for Elon Musk as he takes the helm of all 3 companies? Eventually, he passed off Twitter to a new CEO, Linda Yaccarino from NBC Universal. And then another major theme that we heard was on the tax credits, which helped boost sales and boost deliveries somewhat. And that was a story that started at the beginning as well. We saw a lot of EV tax credits come through, and throughout the year, that really fluctuated. But a big story that I've been following the entire time was Elon Musk's decision to, for a moment, sacrifice margins for deliveries. And he did that by slashing the price of several of Tesla's vehicles in order to boost more of the delivery, more of the output. And it worked. And since he's done that, he's raised the prices of cars back again. Sort of been playing this game to find a good balance each month, really. Not every single month, but months at a time, I'll even say, to find out where we can boost the deliveries and take that short-term margin hit, you know. And so something else really big to note when we talk about Tesla is, I saw a note out from an analyst coming in September that talked about how the services revenue for Tesla is going to be one of the strongest things moving forward. They likened it to how Amazon Web Services, it really does produce the majority of Amazon's revenue at this point, and they believe that the same thing is possible for Tesla.
Absolutely. I think that speaks very much to what Dan Ives was just saying, especially considering Tesla is indisputably the market leader. I mean, as far as its performance this year, but also its reach and its scale, which they have sacrificed margins for. But it seems like it typically pays off for Tesla. It's been a fun one, of course, to watch all year long. Thank you so much, Renita Young, Senior Markets Correspondent for the network. Now, coming up next, we will look at some of the high-profile investors on the network, and I'll be joined by Oliver Rennick to discuss what stood out to him in 2023. That's next on the Schwab Network.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Welcome back to Schwab Network Year in Review. I'm Jenny Horne. Our studio broadcasts live daily from Chicago and from the floor of the New York Stock Exchange, but we also take the show on the road to interview some of the smartest minds in the business.
You told us, I think our last conversation was in the spring roughly, and you said the economy is going to surprise people to the upside. It still has juice left in the tank. We just printed almost 5% GDP. Quick thought on maybe what comes next?
I think basically you have to be worried about another crisis. And the crisis this time is the Mideast and the unintended consequences. We had the bank crisis. We were starting to deal with that. Now we got the Mideast crisis. What else is next? Then you have a house divided. The United States political system needs to be fixed. Then we have to deal with an election 12 months from now. We have a lot of dynamics. The tax cuts that were put in place in 2017 expire in 2025. The deficit that came in at 1.7 billion was close to a trillion, was likely closer to 2. The fact that interest rates are going to be higher for the Fed, that increases the deficit. How are we going to solve and put the U.S. house in order while the world is also a mess? And so, but that's okay. It gives you opportunities to buy stocks at reasonable prices.
Are you worried about the big tail risk event some are with the deficit and the Treasury spending? Or if Powell keeps fighting inflation and keeps the dollar strong, can we print whatever we want?
Well, I'm in the camp that Powell learned a lesson. He's going to have what I said was the 4 R's. Rates higher, longer. I don't know what they'll do next week at their FOMC meeting. The second part is the runoff of the debt. They are taking down a 95 billion a month. That's $1 trillion a year. Basically, then he trying to reduce aggregate demand. That is not working. On the other side, when I look at consumer, 70%, industrial, 12%, government and local spending, the consumer sector has what they call autos. Right now, because the strike is dragging supply out of the system, when that strike is over, you'll have some very strong demand in that sector in January, February, March. It's too late because of Christmas holidays, and so that's going to provide a buttress. Secondly, in the industrial area, well, it has housing, and housing starts, permits for single family are okay, and multifamily are not. But you got the CHIPS Act, the reshoring, and that. So the economy's not so bad.
Yeah.
The problem is we have to help individuals that are at the lower end of the income stream because of the cost of food, fuel, and everything else.
The big worry in the corner of like the hyper bears is that this economic resilience is coming from deficit spending and the stimulus still coursing through our veins. That's going to create the bond market as now a risk as the Treasury keeps issuing more debt to pay for all that. Do you worry about that at all?
Well, you do have to worry about structural deficits being 7% of GDP. There was a long time ago we were really worried when it's 4 to 5% of GDP. Now we're at 7, and that's honestly that inflation's coming down pretty dramatically. We're going to get back into that 2 to 3% range next year. The challenge is, maybe the opportunity is, now you're getting real yields of 2.5% above inflation on 10-year. That's really attractive. For the last 10 years, that was 50 bips or 100 bips, right? Now you're getting 2.5% real yields. So that makes fixed income, all else equal, a little more attractive if I can get 7% kind of yields on a high quality double B or 9% on a high quality leveraged loan with much lower risk in the market. That's really, really attractive. So part of the reason why we've taken our fixed income exposure up from 20% of the portfolio a couple of years ago to 33% today.
And is that on the credit side, corporate side at fixed income, or are you happy to just take on treasury duration risk?
No, I think you want to take duration risk today. Now that you're getting paid for duration risk. A couple of years ago when the 10-year was at 2%, you were getting paid for duration risk. You had no real yield. Now you're getting 2.5% yield. Treasuries do have a role in a portfolio if something really bad happens to the world, right? And there's a lot of bad things that could happen in the world, right? We think about China, Taiwan, what's going on with Russia, what's going on in the Middle East. There are bad events that could happen in the world. Inflation's going in the right direction. I think it makes sense to start buying treasuries, which we started buying last year, and we continue to increase our exposure to treasuries this year as well.
I'm now joined by the host of Morning Trade Live and Market on Close, Oliver Rennick. So, Oliver, you talk to people all day long, every day, that are interviewed so frequently. How do you prepare to stand out and, of course, ask the most compelling questions?
One is just being really glued into the market, trying to weave everybody together so that everything throughout the show kind of has a natural flow. Try to discover themes. If people are talking stocks, another person's talking macro, can we extract some kind of macro theme by the companies that the stock-specific person is investing in? Trying to connect dots all the time, basically, will push people towards useful information for the viewer. So that's the number one thing that we're always thinking about. How to take the information we're getting live and kind of connecting these dots. So if you're watching the shows, a lot of times I'll reference other conversations from earlier in the day, especially at that Impact conference we were looking at, trying to tie together the big themes in a way for that particular event that's relevant to RIAs and some of the big issues they're talking about. Guest by guest, it's just generally knowing what their expertise is, what they're most passionate about. I'm generally not going to be trying to push a topic or a theme that someone is not interested in, right? Or if it's not in their wheelhouse, you're going to get the best content, you're going to get the best answers from people in their area that they're most comfortable with and are experts in. So if somebody has an ETF, we're going to be talking about everything that's in there, which in some ways is kind of different because I'll get a lot of feedback where fund managers will be afraid to talk about their product because they don't want to come off as somebody who's just there hawking their product. And my point to them, I always say, no, that literally is what you should be doing. You have a fund. We want to know what you're doing with it. We're not here to just have you give a comment on what somebody just tweeted or what the market just did. I'll never ask really anybody price targets. You don't hear me when we have analysts on. Yes, that comes into the conversation, but it's not really a priority. I'm much more interested in the reasoning and the logic and the process of somebody's view rather than where they think something's, going.
I think that's a really good point. I think then speaking to what their subject matter expertise is, obviously. Yeah. But in terms of Impact, which we just watched, what really stood out to you? What was like your favorite takeaway?
Well, it was a great event, and Michael Phelps at the end was awesome hearing him talk. But market-related and thematically, the Gabelli interview was very good. The team from T. Rowe Price was really good. I mean, you had a lot of really smart people there at a moment where the market was inflecting in a very fascinating way. So around that time, we really had one of the biggest stories of the year taking place, which was this uninversion of the yield curve in the second half of the year that was happening without any actual cuts and really before the market started getting super aggressive in its pricing of cuts. This was, as you heard with Gabelli, right after we got the first look at 5% GDP, which was like an absolute stunner. So you had the first half of the year where there was a lot of deep concern about what was going to happen because of regional banks. You heard Gabelli mention that. Bunch of geopolitical flare-ups happening again, but yet at that moment the bond market was repricing into this like fresh new cycle of growth, which was really unprecedented in history for the bond market. So that was kind of the anchor through which every conversation was centered.
So, okay, now I'm curious because we know as reporters, sometimes the markets aren't that interesting. And sometimes things do get relatively quiet. We talk about these summer trading days. How do you prepare for interviews on those days without asking basically the same question over and over?
We go Twitter, search Cybertruck, and find videos and talk about Cybertruck videos.
That's exactly what we do.
Yeah. Well, it is actually kind of challenging. I mean, in the last month of the year, as stocks melted up, you have a very different type of coverage. When the market's under stress, it's about trying to figure out where the stress is coming from, how real is the stress, how bad could it get? Almost like damage control and kind of assessing how deep, does that cliff go? Where is the cliff? So as the market turns into something different and becomes very positive in its tone, it's a different type of coverage because now it actually gets more challenging, to your point, in a way, because people are a little less alert. Your general tone pacifies, so the conversations are not as intense. But there's a lot of fun that is from my overall market reporting experience, which was covering markets in a decade where they just basically went up until COVID. And you get really creative in the way to frame those days. So, all right. What kind of rally was it? What was leading? What was lagging? What's the contour? I think a lot of times about the word contour because there is this market shape that's bullish and it's moving in a direction, but different days, certain areas are protruding and others are retracting, and you're constantly trying to assess marginal changes, which means you kind of got to pay attention. It requires the viewer to be a little bit more kind of like hyper engaged, and sometimes it can be airbrushed a little bit, and you have to be careful not to slip into that too much.
And it does require, I think, a little bit more critical thinking from yourself, of course, as the interviewee. Yeah. But what will you, I think this is a hard question because it's so broad, but curious your thoughts, what you'll remember about markets in this year.
This year is definitely about the swing from a massive economic downside risk into an almost euphoric growth mode, which just, again, doesn't really have a lot of precedent. So it kind of takes a few forms. We had two big themes, which were the AI-driven tech earnings potential. There was real groundings for earnings, and then there was this big expectation of a Fed pivot towards the end of the year. But the most important thing for 2023 was going from an inverted yield curve to a steepening one without any cuts. We didn't totally uninvert the yield curve, but we got very close, and it's the first time in history it happened without cuts in the moment. It just happened because the long end started repricing growth, and that's never really happened in markets ever. And we don't know the answer to what comes next, but so far it's a much better than expected outcome than anybody thought in the first half of the year.
And that's what happens. Like every year ends up being perhaps more interesting than we even anticipated going into that year, which is what's fun about it. But
last 5 years for sure.
No kidding. But appreciate all that insight as always, Oliver. Now up next, we will take a look at some of the sports world superstars who did stop by our set at the NYC, including an NBA MVP as well as a Super Bowl champion.
There's no place like the New York Stock Exchange. We've got you covered. The biggest stocks, the biggest trends, all the market moves. The Watch List with me, Nicole Petalides, 2 p.m. Eastern on Schwab Network. Eli, when you look at the other athletes and you're trying to tell them to get on board, is there anything that you would say to them from the day one? Like, would you start to give them advice?
I would tell them what my dad always told me is you never go broke taking a profit. And he used to use that in football terminology, saying, hey, find completions. You don't have to throw the home run. You don't have to throw the 50-yard post route. You can just, hey, throw it to the running back, get 4 or 5 yards, just, moving down the field towards that touchdown.
You never know who may stop by the floor of the New York Stock Exchange. Wall Street is, of course, the heart of the financial world, and Nicole Petalides is able to bring you 2 hours daily live from the floor. Earlier this year, she sat down with Milwaukee Bucks superstar Giannis Antetokounmpo to discuss his transition from Greece to then 2-time NBA MVP to now the world of finance.
I'll start with Giannis and just ask you about why you've decided to move forward in this way. You've been very philanthropic. You've had a long journey, which I'm going to ask you about, but why now and why ESG?
I think I'm ready. Obviously, met Mr. Koudounis from a friend. my agent and Mark Lazzi introduced us, and we had conversations, and we share similar values, and we want to give back. We want to teach the youth about financial literacy and use our platform that we have for access for people to invest their money.
And that's something that, and I'm going to get to this, but that was something when you were younger. You came from Nigeria to Greece to America and achieved your dream. But you didn't have an understanding of financial literacy and access, and that's something that you want to share. John, you have over 30 funds at Calamos, but this is something the clients are clamoring for, I understand.
Well, this is a very special fund, and it gives us the opportunity to give back. And I think it's really, really important to take a step and think about what's happening in the whole world and give people, not everybody needs to do this, but the opportunity to invest in ESG. It's the fastest growing sector. Within a couple of years, they're projecting to have over 53 trillion of investable assets of a total of 140. That's a third of all investable assets will be in ESG. Mm-hmm. So it's here, it's not a fad, and we wanted to make sure that we're doing it right and to partner up with someone that shares our values. And there's also a component of the fund that we're giving back 10% of the profits of the JV to different causes that are dear to us. Right. And a lot of it is financial literacy. And I think it's something that we're really, really proud of doing. Yeah. If we can make a little bit of positive impact, point some people to the right direction, then I think that it's a great thing.
So this is, when you say JV, this is a joint venture. You're doing this together. You're 50-50 on this. You're not a spokesperson. You've been at the board meetings. You have your own charities. You have your Charles Antetokounmpo Family Fund. You did the Maverick diapers. I know that you've been doing things along the way, but how is this different? I mean, what's the experience been like?
It's totally different. I'm getting my feet wet. You know, at the end of the day, I have great people around me that helped me through this process, and I learned so much from them. But just being able to give back 10% to financial literacy and education, that's big for me. As I said in the beginning, growing up, I didn't have access. Mm-hmm. And it wasn't just because I didn't have access. Like, my father knew nothing about financial literacy, so I had to learn by myself when I came to the States at 18 years old. So just being able to give back and help people have access, teach them how to invest their money. It's okay to invest your money. You don't have to be scared, because both of my parents were scared. And I kind of had that fear installed in me until I kind of grew out of my shell and I realized that money makes money faster than people can, and I was willing to make the risk to invest my money. But having great people around me that allows me to use my platform to give back, it's huge, that it was no-brainer to join forces.
I really love this story. I do wish you all the best of luck. I did have them pull up a picture of you and your family when you were young, and I think about your journey, and we've heard so many stories how you and your brothers were selling wares, watches and DVDs and things in Greece, you know, along the way. I heard you shared one pair of sneakers and a game with you, maybe that was with Thanasi. Who'd you share the one pair of sneakers with?
Thanasis.
Yeah. And then I heard another story, true or false, that when you came to America and you were playing for the Bucks, and you were very young, I think you were 18, that you were sending money home to Greece. I really would like to know if this is true or false. And you were running to the game, no jacket, freezing cold in Milwaukee, but you had a situation. You didn't really have money or a car or whatever. What happened?
Yeah, I was 18. I didn't have a driving license when I came, and I took my first paycheck, so I sent it back home. And I went to the ATM, withdraw money, and I didn't know my card had a limit. So I went into a cab and I asked to pay with my card, and he was like, he accepts only cash. And I'm like, okay, I have a game in 30 minutes, so I gotta make something happen here. I went to the ATM, I couldn't withdraw money. So I'm like, okay, I have the option. I'm gonna wait here, but I'm just gonna start running to the arena. So I started running to the arena, and thank God somebody saw me in the cold. I didn't have the coat with me, picked me up. It took me to the game. But this is me. This is a way that I figured everything out. how to open a bank account, how to invest my money, how to get my driver. Like I figured everything out by myself, but thank God I had great people around me to mentor me through all this process, and it's been an awesome journey.
I'm now joined by Nicole Petalides, the host of Trading 360 and The Watch List. Nicole, can you tell us about the clear advantages of being on the floor of the New York Stock Exchange during your shows and throughout the trading session?
I love it here, and it never gets old. You come up Broad Street and you see the beautiful facade, the front of the New York Stock Exchange, and no matter what your mood is, you are ready, because that opening bell rings so loud at 9:30 and the hustle and bustle starts, and you know you're in the financial capital of the world. This goes back to the 1700s, where you had 24 brokers on Wall Street that signed the Buttonwood Agreement, and here we are today. And this gives us the opportunities that we never would have if we didn't have our space, Schwab Network, here on the floor of the New York Stock Exchange. So this is the place where I see traders every day. I can walk into any booth and see why something is moving. You never saw so many charts in your whole life. And in addition to that, every one of these traders that's on this floor has phones to upstairs. So you're getting breaking news in a huge fashion. We've had so many CEOs and executives and analysts and experts, but how about people from the NBA, Giannis Antetokounmpo, with his ESG ETF along with Calamos. We had Eli Manning and his money manager, DK Metcalf. So we've had a great year, and this, having our floor presence here, makes all the difference. It's really important that we're here at the New York Stock Exchange, and every day is a new exciting day.
So what will you remember the most about markets in 2023?
2023. Well, I remember the year 2000 and when we broke 10,000. There are so many years to look back on, but 2023, first I'll start with that it's bittersweet. No one likes war. And we saw terrible things happening. Russia, Ukraine, Hamas, Israel, Gaza. All those things were very difficult to digest. How does it affect the markets in the meantime? We're looking at the markets and the year that was, and some of those did affect the markets at times. But more importantly, we are looking now at your money. And when we were going into 2022, we had a global coordinated effort of central banks where all the central banks were hiking. 2022 was tough. 2023, people were, had some PTSD, and then they had the surprises of the Magnificent Seven, and they had the surprises of AI, and they had a great real run for the markets, only to have it beaten down in August, September, October, but at year-end excitement with weeks of gains, records for the NASDAQ, won all-time highs, NASDAQ, Dow. And then I think about specific stories that sort of cleaned up the markets, right? You had those regional banks, because of the trajectory of those Fed rate hikes, you had SVB and some of those regional banks that got hit so hard, so fast in March. You had obviously regulators step in, but that was a big story, and it was a nerve-wracking one. You had the cleanup of Bitcoin, right? You had FTX, you had the Binance chief out, and Bitcoin had an incredible year. So that's something that I watched. And then I just love to see the old stories. We were talking about Uber. And this was a name, I remember the IPOs of Uber and Lyft, but it was all about Uber's path to profitability. And look what happened now. The stock is at 5-year highs. It is profitable. They see the innovation. They're doing Eats. They're doing grocery delivery in addition to ride sharing, and has entered into the S&P 500. It is so exciting to be a journalist and watch companies from their infancy grow and become behemoths. We've seen mergers and acquisitions, whether it's healthcare and energy, but I'll leave it on something fun and maybe a little silly, but Barbie, Taylor Swift, and next year people are looking to cuts, and hopefully people can handle those credit card debts, but a presidential election year, a lot of excitement looking forward to 2024. And as we wrapped up 2023, we saw some records. And so that's probably pretty good for those 401ks and IRAs.
Thanks so much, Nicole. Now, coming up next, we'll close out the show by looking back at our sit-downs with the CFOs of General Motors and Moderna as they navigated the challenges of 2023. That's next on the Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back. As part of our coverage, we are joined by not just investors, but also the heads of some of the biggest companies in the country. Nicole Petalides sat down with General Motors CFO Paul Jacobson to discuss the outlook for one of the country's largest legacy auto players.
When you look at General Motors and you look at the quality of the products that we have and the amazing customer response that we've seen really over the last few years with a lot of our new model SUVs and new model midsize trucks, customers just can't get them fast enough, and that's been great for the business. We've continued to perform well, both on average transaction price as well as consumer demand. That's driven us to raise our full year guidance twice this year already, both on the EBIT line, EPS line, and also on free cash flow. So things are going really, really well.
There's no doubt there is stiff competition here at home and abroad. In China, for example, we're seeing BYD taking huge market share, Tesla and all the other names abroad. How do you battle it out abroad, and what do you see as the China picture for the company?
Well, we've been investing very heavily, particularly into EVs over the last several years with a battery platform that is helping us to lead as well. We've started to ramp up production pretty quickly. We produced 50,000 EVs in the first half of the year. We're expecting to deliver 100,000 and produce 100,000 in the second half of this year, up to 1 million EVs in 2025, all based on that Ultium platform. So as we continue to ramp up production with new electric products like the Chevrolet Blazer, as well as the Silverado EV. And then we revealed just last week the new Escalade IQ, which will be available next year as a full EV version of the highly successful Cadillac Escalade. We've got a great product suite that's coming to America. We're doing some imports and also some EVs in China. And we're really starting to leg into that and expect those to drive to low to mid single digits margin profitability in 2025. So we've got our work cut out for us, but certainly we feel really good with the products that are coming to market.
General Motors also had to navigate the auto worker strike, which lasted roughly 6 weeks before a deal was finally made. Another company that faced adversity in 2023 was Moderna. Shares plummeted as revenue from its COVID-19 vaccine declined. Oliver Rennick sat down with CFO Jamey Mock back in November to discuss the company's overall plans going forward.
I think looking at this as traders and investors, there's sort of a very obvious element to what's happened with your guys' company, and then there's maybe a little bit more unknown. The obvious part is that we all knew that eventually post-COVID, whenever that kind of world emerged, that the vaccine makers like yourself would struggle with the declining sales. But at this point, it seems like the analyst community has still been surprised by maybe the extent to which people aren't getting vaxxed. Or tell me what, in your mind, maybe has unfolded in a way that you didn't quite expect.
Yeah, so thanks for the question. So yeah, particularly what's unfolded was we had a wide range of outcomes, particularly in the United States from a vaccination rate. So at the end of our last quarter, we guided $6 to $8 billion of global sales for the year. And that range was really dependent upon essentially whether COVID vaccination rates in the United States mirrored last year's vaccination season, which was a little over 50 million vaccinations, or what we thought might have a chance that it should go up. Because if you look at it, COVID is 3 times the burden of disease for the healthcare system than flu. And flu is 150 million shots per year that Americans take. So we think that it'll go up over time. But what's turning out here is that we're actually on the lower end and closer to last year's fall season.
And is that, it sounds like it's not necessarily a result of like weather, fewer sicknesses in general? It's just that people are choosing not to get the booster, or are they getting like a more traditional flu shot? It's a choice being made, right, that it seems is surprising a little bit.
Yeah, so as I mentioned, 150 million Americans every year on average, and it's been pretty consistent over time, go in and choose to get a flu shot.
Mm-hmm.
And so our belief is that someday that the amount of people choosing to get COVID should at least mirror that, because COVID is actually creates more hospitalizations, creates more deaths. But if you look at 2022, only 50 million Americans chose to get a COVID vaccination or booster. And it looks like through the month of October, we're actually trending closer to that. So it seems like we now have 2 data points in a row, year over year. And so I think there are reasons to believe why it could grow over time, but at least for the foreseeable future, it's on the low end of that range.
When you talk about it growing over time, so then is the idea that people will just get a COVID booster instead of what they would have done as a traditional flu shot, so that it's like a one stab fits everything? Is that kind of like the idea that it will replace a traditional flu shot?
No. So good question. No, we need 2 vaccinations for flu and COVID. They are different infectious disease that you need to vaccinate against. However, we are at work, and we just announced results on our phase 1/2 trial and have just started a phase 3 trial on what we call a combination vaccine, which actually includes both a vaccine against the flu and a vaccine against COVID. And I think that actually will help more Americans get a combined flu and COVID shot, which should increase the number of people that get a COVID vaccine over time, because it's much more easy from a convenience perspective for anybody, as well as the technician, to administer just 1 dose versus 2.
That's very interesting, and I think that's really getting to the point here. How do you, make financial expectations without, I guess, kind of knowing where the COVID virus will go? Because, I mean, it's the first time we've seen this thing. Obviously, well, the initial onset was the first time we saw something like this. And how do you make that distinction between whether or not one needs the separate COVID vaccine, or do you guys just feel that going forward, every season comes around in perpetuity, people should think about getting a COVID vaccine? Or will there come a day, in theory, where, oh, there's little COVID going around anymore, we don't need the vaccine?
No, we unfortunately believe COVID is here to stay, and that it will change, and the strain will change, and it'll mutate over time. So unfortunately, I think it is here to stay. We actually, in the quarter, resized our manufacturing capacity and took some charges around that to get ready for that new endemic volume.
Understood. Okay, because that's where it gets, from a financial perspective, it seems pretty tough. It's like having to have these kind of ranges of outcomes and adapt to them. What about the financial potential for other revenue streams? I know that you've got the RSV drug coming down the pike next. It seems to be one that investors are talking about. Where does that visibility show up right now in terms of either cash flow or commercial availability for the non-COVID drugs?
Yeah, great question. Glad you asked it, so I appreciate it. Maybe big picture, and then I'll get to RSV.
Sure.
Big picture, we said we're actually going to launch 15 new products and drugs in 5 years, so 2028. We said that at our recent research and development day. So we're very excited about that, and we think 4 of them will launch by 2025, largely in respiratory disease, which RSV plays a role in. So we've filed for RSV from a regulatory perspective to get approved, both in the United States as well as many countries throughout the globe, and we expect that to come to market in 2024. So as of right now, it is purely an investment for us, and in 2024, it should generate profits for us. And similarly, we are hard at work at flu, as well as the combination vaccine that I talked about, as well as an upgraded COVID vaccine to make it more refrigerator stable. And all those we believe will launch in 2025. So yes, I mean, historically, we've been, a COVID company for the last few years. But starting in 2024, I think you'll see a much bigger respiratory business. And then by 2028, you'll see an oncology business. We have terrific results in immunotherapies and help there, as well as rare disease and latent disease as well. So we're really trying to broaden the portfolio and diversify the portfolio to not just be a COVID company and not just a respiratory company as well.
Thank you for joining us for our 2023 year in review. From all of us here at the Schwab Network team, have a wonderful holiday, and we'll see you in 2024.